Welcome to The Explainer, where we break down the big ideas. So today we're going to tackle two totally different ways to think about investing. Are you chasing capital gains or are you building cash flow?
All right, let's just dive right in by taking a swing at maybe the most common piece of financial advice out there. You know the one, work hard, save your money. We've all heard it. But what if that's actually terrible advice for today's world? What if the safest thing you think you're doing, saving money, is actually the riskiest?
You see, when you dig into it, the whole idea of just stashing your cash away has a couple of massive flaws, and they can quietly, silently, drain your wealth without you ever even seeing it happen.
And that quote really just hits the nail on the head, doesn't it? This gets to the very first problem, the money itself. A dollar isn't what it used to be. It's not this stable thing you can just put under the mattress anymore. Yeah, a dollar in your bank account is still a dollar, but what that dollar can buy you, well, that's shrinking every single day.
This is the perfect way to think about inflation. Imagine the whole economy is one big pizza. Printing more money doesn't make the pizza bigger. It just means you have to cut it into more and smaller slices. So every new dollar that gets created makes every single one of your dollars just a little bit less valuable.
And here's where the math gets really, really ugly. I mean, look at this. Your bank might give you what, less than 1% on your savings? But if inflation is running over 3%, well, your money isn't just standing still. It's actively going backward. You are quite literally losing money by saving it.
Okay, so that's problem number one. But there's another monster lurking in the closet, market risk. If all your savings are tied up in, say, a 401k, you're basically strapped to the market roller coaster. And when that roller coaster takes a dive, it's not crazy at all for those accounts to get cut in half, wiping out years of hard work.
And this, right here, illustrates the absolutely brutal truth about recovering from a loss. Think about it. If you have 100 grand and it drops to 50 grand, that's a 50% loss. But to get back to where you started, back to 100 grand, you now need to make $50,000 on your new, smaller $50,000 base. That's a 100% return. Falling down is easy, climbing back up is twice as hard.
So what do? These two huge problems, your money losing value and the market crashing, they basically force you to a fork in the road. You have to pick a side. You have to choose between two completely different philosophies for how you're going to build your wealth. Now, the first path is the one most of us are already on, probably without even realizing it. It's investing for capital gains. This is the whole buy low, sell high game. You buy a stock or a fund, and you just hope. You hope that someday someone else will pay you more for it. Your entire net worth is just riding the waves of the market, up and down. But then there's the other path, investing for cash flow. And here the goal is totally different. It's not about selling the asset, ever. It's about owning assets that act like little money printing machines, things that put cash directly into your pocket, month after month, quarter after quarter. So let's just boil this down, right? One strategy, capital gains, is really just speculation. You're betting on a price change you can't control. The other strategy, cash flow, is about building an actual income stream. So even if the market takes a nosedive and the value of your asset goes down, who cares? You're still collecting the rent.
Okay, so this cash flow idea sounds great, but how do you actually do it? How do you make your assets start paying you? Well, the sources we looked at point to a couple of really powerful ways to get this engine started.
The classic example, of course, is a rental property. The price of the house can bounce all over the place, but it doesn't really matter day to day. As long as you've got a good tenant paying rent, you take that check, pay your mortgage and other bills, and whatever's left over, that is pure cash flow, right into your bank account, every single month.
But you don't have to be a landlord to get cash flow. You can do it with the stocks you already own. The best way to think about it is that you're renting out your stocks. You do this by selling something called an option, which is basically an agreement. You get paid cash right now, today, in exchange for giving someone else the option to buy your stock from you later at a price you set.
So why would this even work? Well, it's because of this amazing invisible force that's always on your side, something called time decay. Seriously, think of that rental agreement, that option, like a melting ice cube. The day you sell it, it has the most value. But with every single day that ticks by, a little piece of it just melts away. And that value that disappears, it melts directly into your pocket as pure profit. So you can see the process here is actually pretty simple. You get paid cash upfront for just being willing to sell your stock later on, at a price you'd be happy to get anyway. And the best part? That cash, that premium, it's yours to keep, no matter what happens next. The stock can go up, down, sideways, it doesn't matter. You're literally getting paid just for letting the clock tick,
At the end of the day, though, this isn't just about learning a few new tactics. It's about a complete shift in your mindset. It's about changing how you see the entire game of money and building wealth.
Now, this quote, this is one of those ideas that can really just flip a switch in your brain. In an economy where money is constantly losing value, the cash you have saved is that melting ice cube. But what about debt? Well, if you have a fixed-rate loan, like a 30-year mortgage, that debt actually gets easier to pay off over time because you're paying it back with future dollars that are worth less and less.
And this leads to the ultimate goal, which sounds like some kind of magic trick, achieving an infinite return. But it's not magic, it's just math. You use someone else's money, like a bank's, to buy an asset. If the cash flow from that asset is enough to pay back the loan, plus all the expenses, and there's still money left over for you, then you basically have a money-making machine that you got for $0 out of your own pocket.
So what this does is it completely changes the most important question you ask before making an investment. The average person asks, how much could this be worth someday? But the sophisticated investor asks something totally different. How fast can I get my original money back out of this deal? Because once your initial capital is safe and back in your pocket, you're just playing with the house's money, with the free asset that keeps paying you forever.
And that brings us to the final question, the one I want you to really think about. Take a hard look at your own finances, your retirement account, your savings. Is your money just sitting there, passively, waiting, hoping for a price change that you have absolutely no control over? Or is it actively working for you, putting cash in your pocket month in and month out?